If you're a freelancer or independent contractor and you've been focused on where to invest your money, I need you to pause on that for a second. Because there's a very good chance your tax and business structure is quietly costing you thousands of dollars a year, and nobody in your corner is saying a word about it. And here's what's frustrating. It's not because the strategies are complicated. It's not because there's some secret only available to wealthy people. It's because the strategies that would actually help you the most are also the ones that don't pay your advisor anything to explain them. So that's what this video is about. We're going to go through 3 specific strategies that freelancers and gig workers should be asking about way earlier than they usually do: the qualified business income deduction, the S-Corp election, and one solo 401k feature that almost nobody brings up. I've gone deep on all 3, and what I found is that the reason these don't come up in most advisor conversations isn't complicated either. It follows a very predictable pattern, and once you see it, you can't unsee it. Quick note if you're new here: in the last video, we broke down why standard financial advice often fails freelancers. We covered the SEP IRA trap, the pro rata rule, the solo 401k, and how the way advisors get paid can quietly shape what they recommend. If you haven't seen that one, I'd go back and watch it after this because it gives a lot of context for what we're about to get into. Link is in the description. Now let's get into it, starting with something that I think is genuinely underrated. The qualified business income deduction, most people just call it the QBI deduction, is one of the most valuable tax breaks available to self-employed people right now. And the wild thing is that most freelancers who qualify for it don't fully understand how much it's actually doing for them, or worse, they're not claiming it correctly. Here's the basic idea. If you're self-employed and you have what the IRS considers qualified business income, you can deduct up to 20% of that income from your taxable income. So if you're netting $60,000 from your freelance work, that's potentially a $12,000 deduction before you even get to anything else. If you're sitting in the 22% tax bracket, that's roughly $2,600 back in your pocket just from that one deduction. No product to buy, no account to open, no ongoing relationship to maintain. And for most freelancers, specifically those earning below around $191,000 as a single filer in 2024, you qualify for the full 20% with no restrictions. There's no W-2 wage test, no property calculation, none of the complicated formulas that apply to higher earners. You just qualify. Your CPA handles it on your return. So why doesn't your financial advisor bring this up? Because there's nothing in it for them. It doesn't create an account they can manage. It doesn't generate a fee. It doesn't require their ongoing involvement. It's a deduction that lives entirely in the tax world, not the investment world. And so it often gets skipped over in favor of conversations about portfolio allocation, which do require their ongoing involvement. That's important on its own, but the next one is where things get even more interesting, because this one can save you significantly more money, and it comes up even less often. If you're a freelancer earning above roughly $40,000 to $50,000 in net profit, you need to at least understand what an S-Corp election is. I'm not saying it's right for everyone, but the math is worth knowing. Here's how it works. When you operate as a sole proprietor or a single-member LLC, you owe self-employment tax on all of your net earnings. That's 15.3%, which covers both the employee and employer share of Social Security and Medicare. When you work for someone else, your employer pays half of that. When you're self-employed, you're paying both halves yourself. So on $80,000 of net income, you're looking at over $12,000 in self-employment tax before a single dollar of income tax even enters the picture. And S-Corp changes that math. When you elect S-Corp status, you split your income into 2 buckets. The first is a reasonable salary that you pay yourself as an employee of your own business. The second is a distribution, money you take out as the owner. And here's the key part. You only owe self-employment tax on the salary portion, not on the distributions. So if you restructure that same $80,000 into a $45,000 salary and $35,000 in distributions, you're only paying self-employment tax on $45,000 instead of $80,000. Depending on your specific numbers, that can save you anywhere from $3,000 to $15,000 per year. The setup cost is usually a few $100s with a CPA, and there's a bit more administrative work involved compared to running a simple sole proprietorship. But for most people in that income range, the math works out very favorably, and your financial advisor almost certainly isn't bringing this up. Not because it doesn't work. It absolutely works. But because setting up an S-Corp is a CPA function, not an advisory function, there's no portfolio to manage, no AUM to charge against. So it stays off the radar. The conversation never starts. Now I want to go back to the solo 401k for a second, because there's one feature of this account that almost nobody talks about, and it's particularly valuable for freelancers who deal with inconsistent income, which is basically all of us at some point. A solo 401k allows you to take a loan against your balance, up to 50% of your vested balance or $50,000, whichever is less. You pay yourself back with interest, the money stays inside your retirement account, and there's no early withdrawal penalty. For a freelancer who hits a slow quarter and needs cash to bridge the gap, maybe a client fell through, maybe a project got delayed, this is a real option that doesn't wreck your retirement savings in the process. Compare that to a S-Corp IRA, which has no loan feature at all. If you need money out of a S-Corp IRA, you're taking a withdrawal. That means income tax on the full amount, plus a 10% early withdrawal penalty if you're under 59.5. So what felt like a safety net turns into a pretty expensive emergency fund. But because the loan feature doesn't generate any advisory fees, it's not something advisors tend to highlight. The S-Corp IRA keeps getting recommended as the simpler option, and the solo 401k loan feature just quietly sits there, unmentioned. And this is the pattern that freelancers really need to recognize, because once you see it, it changes how you evaluate every recommendation you receive. The strategies that can actually move the needle for you, the ones that can save you real money in real dollars, are often not the ones being sold the loudest. The QBI deduction reduces your taxable income without requiring a product. The S-Corp election reduces your self-employment tax without requiring an investment account. The solo 401k loan feature gives you flexibility and a safety net without requiring your advisor to manage those assets. None of these generate ongoing fees. None of them create a reason for an advisor to keep you in the relationship. And so none of them tend to come up early enough, if they come up at all. Now, if you're finding this useful, I'd genuinely appreciate it if you hit subscribe, because the next video in this series goes even deeper into the advisory industry itself, and it's one that I think a lot of freelancers are going to find pretty eye-opening. It's worth being here for that one. And if you know another freelancer or contractor who's been getting the standard just open a SEP IRA advice, send this their way. This is exactly the kind of thing that's easier to understand when someone just lays it out plainly. But let's get back to the bigger picture here, because there's something connecting all three of these strategies that I don't want to gloss over. Your business structure, your tax setup, and your retirement account choice are not separate decisions. They are connected, and the order in which you make them matters. If you choose the wrong retirement account first, say you go with a S-Corp IRA because your advisor said it was simpler, you may create a tax problem that complicates your ability to do a Roth conversion later. That's the pro rata rule issue we covered in the last video. If you ignore the QBI deduction, you're leaving money on the table every single year without even realizing it. If your income is high enough and you never think about an S-Corp election, you keep overpaying self-employment tax indefinitely. These things stack, and if you're relying only on standard advisory recommendations, you may not hear about any of them until you've already been losing money for years. The question most freelancers are asking is, what should I invest in? And that's a reasonable question, but it's the second question. The first question, the one that actually has to come before it, is whether your business and tax structure is set up correctly in the first place, because no investment decision is going to outperform the savings you get from fixing a broken structure underneath it. Think about it this way. If you're overpaying $8,000 a year in self-employment tax because you never looked at the S-Corp option, and you're leaving another $20,600 on the table because you're not fully utilizing the QBI deduction, that's over $10,000 a year. Compounded over a decade, we're talking about a genuinely significant number, and you could have addressed both of those things with a good CPA conversation, not a financial product. So the practical takeaway here is pretty straightforward. Before your next conversation with a financial advisor, or before you open any new account, sit down with a CPA who actually works with self-employed clients and ask three specific things. First, am I claiming the QBI deduction correctly and fully? Second, at my current income level, does an S-Corp election make sense for me? And third, does a solo 401k make more sense than what I currently have, given the loan feature and the higher contribution limits? Those three questions alone could change your financial picture in a pretty meaningful way, and none of them require you to buy anything. Now, I want to be clear about something. This video is for educational purposes only and is not personal financial, tax, or investment advice. Everyone's situation is different, and the right answer for you depends on your specific income, your business structure, your state, and a bunch of other factors that a qualified CPA or financial professional needs to look at. So please take this as a starting point for better conversations, not as a substitute for getting actual professional guidance. But here's what I want you to walk away with. The most valuable strategies available to freelancers are often the simplest ones, and they're often the ones that don't require ongoing advisory involvement. That's not a coincidence. It's a structural feature of how the advisory industry works. And once you understand that, you can start asking better questions, working with the right professionals, and keeping more of what you actually earn. In the next video, we're going one level deeper into the advisory industry itself. We're going to talk about why many financial advisors are actually 1099 workers too, why commission-based advice can become genuinely dangerous for freelancers specifically, and how to think through the full system without assuming that every recommendation is automatically in your best interest. That one is going to be worth your time. If you've made it this far, drop a comment and let me know. Are you currently working with a CPA who actively brings up strategies like these? Or has it mostly been crickets? I'm genuinely curious where people are at with this, and it helps me figure out what to cover next.